You are still watching Business Morning on Channels Television, and the outbreak of coronavirus has attracted the attention of multilateral financial institutions and, of course, central banks around the world, forcing regulators to release some fiscal stimulus. My colleague Temple Ashajo will be looking at this coordinated stimulus package by central banks and multilateral institutions with the head portfolio management at Commercial Partners Asset Management, Victor Ayeni. Temple.
George Meze, thanks a great deal for joining us here. We got Victor Aluyi right here from Commercial Partners. He's the head of portfolio in the establishments. Thank you so much, Victor, for joining us again this morning. Such a privilege to have you on the show. So we've got lots of these funds now being churned out by multilateral financial institutions like the IMF. We've seen central banks also reacting positively to this development, coronavirus, and of course some fiscal stimulus packages. We've seen the one from US, the one from UK, and a couple of other nations are considering, releasing some funds. How would you say the markets generally are receiving these particular funds that has been released, across the globe, I should say?
Okay, I think what you're having is, if you will, an unprecedented global coordination by monetary authorities to try and assuage the impact of the outbreak and the spread of the coronavirus. What the Federal Reserve did over the weekend was also quite drastic, cutting those rates to zero, and then also looking to buy U.S. Treasuries of up to about $700 billion, essentially deploying the quantitative easing tool at this point. If history is something to go by, you look back at the financial crisis of 2008. What had happened then was the credit crisis, and the Federal Reserve obviously cut rates also to zero and then deployed the quantitative easing tool. As a matter of fact, we had 3 rounds of quantitative easing, QE1, QE2, and also QE3, where the Federal Reserve essentially increased its balance sheet somewhere from less than $1 trillion to over $4 trillion within this period. The idea basically at the time was to essentially reflate the economy, create ample amounts of liquidity that would engender great economic activity. And, looking at that period, we had asset prices move in various directions. For the safe haven assets, initially we basically saw them react negatively on the onset of the financial crisis. They had moved up quite significantly, but through the various rounds of quantitative easing, we saw risk assets, go up quite significantly. And the QE that was implemented, post the financial crisis was the prelude for the longest bull market that we've seen in U.S. history. So clearly what is going on now is slightly different. You essentially have a biological crisis. However, what the Fed and other central banks are essentially doing is to envisage a situation where the biological crisis leads to a credit crisis, because that is, we're seeing a semblance of that right now. Markets are shutting down, economic activity is shutting down across major regions of the world. First it was China. The epicenter has shifted now to Western Europe, and you're having a significantly increased number of cases in the United States. You're also having parts of the US going on lockdown, major parts of Western Europe going on lockdown. These are major economic engines for the global economy. And as those continue to shut down, you are likely to see a credit crisis ensue. So what the Federal Reserve and other central banks are essentially doing is to create a measure that would provide or ring-fence that risk of a credit crisis that could ensue down the road. Like I said earlier, a monetary policy adjustment would not necessarily address this situation because, again, it's not a credit crisis. That's not the root cause of it. But again, this situation, this biological challenge could lead to a credit crisis, and the central banks are saying, let us put these measures in place so that when we indeed get to the point where we could have a credit crisis, we have measures in place to ensure that the impact is significantly ameliorated or assuaged, to ensure that the global economy remains resilient and still competitive. So I think that's the major reading from what the central banks are currently doing.
From your research, do you think folks have started to, tap into these funds in any ways? Because I know that some of them are for households, some are like buffers for businesses, for folks that have already taken credit and all of that.
Mm-hmm. Yeah, well, I mean, it's still kind of early days to say. I mean, these measures were rolled out just a matter of hours, weeks ago, about a week ago, actually. So I think we will begin to see the impact. However, markets really don't like uncertainty. And when the Fed made that move, it's a basic assertion that, the U.S. economy is probably going to take some heat down the road, and markets don't like that. That's the reason markets have reacted the way that they have and have remained, wildly volatile over the last week plus, So the reading from markets is that if you're cutting rates this much, if you're going into quantitative easing, you're basically telling us that it's really rough out there. And so markets don't necessarily like that, tone from the Federal Reserve. However, I think these measures will prove very significant. They will prove important in calming nerves even going forward, because I think it would be worse that central banks just didn't do anything about it. So the fact that they are doing this, yes, it sends a nervous signal out there, as to the state of the economy and as to the state of things that are likely to come from the Fed's own perspective. Nevertheless, it also throws in, that sort of soothing feeling to say that the banks are ready to support the global economy as things unfold.
So is there any way the portfolio investors can benefit from these particular packages? I know they are all targeted at the real sector, but the portfolio investors, across the world also play a very, very significant role.
Absolutely. I mean, for what the Fed is doing, for instance, they're buying U.S. Treasuries, right? And then we've seen, those U.S. Treasuries, decline quite significantly just on the back of that news. So right now, really, again, if you look back at 2008, the sentiment is essentially the same. Right now, it's really safety first. Like I said earlier, if you're in the eye of a storm, you really want to stay safe. The storm is still raging. We're essentially pretty much like still in the eye of that storm. You just want to stay safe. Once the eye passes and the storm, is showing signs of abating or beginning to subside, at that point you want to look at the things that you are likely to do. Nevertheless, there are opportunities within a storm, but it is important to stay safe at this point, really.
So all of such programs like the asset buyback that the U.S. is doing, the bond purchase program, 120 billion euros or thereabout for the one released by ECB last week, should actually be something that this portfolio investors can actually tap into.
So typically what would happen is once you have quantitative easing, you've got a wall of money out there, looking for yield or looking for assets. Unfortunately, what we have right now, there's a great risk-off environment. So even with that wall of money, I don't know that money would essentially be looking for yield, at least in the short term. Safety will be a key word, for that money right now. But of course, as things sort of clear up a bit, you would want to see those monies looking for yield, where they can pick it up.
Do you think this could become detrimental for these central banks eventually? Because you look at the like of, so ECB played safe. Folks were expecting them to actually go a bit to some negative of 0.6%, but they did 0% to 0.5. They actually left it unchanged. I mean, that's the former IMF managing director. But if you look at the Fed itself, did 50 basis point first, I think, and then cut down eventually to 0. That's like twice a move in a week and all that. I mean, how detrimental could this be for them eventually?
Well, the truth of the matter is that coming from 2008, there have been concerns around the, bloating of Federal Reserve balance sheets. There are also concerns around, ballooning corporate debts around the world because essentially money had become really, really cheap. I think right now in the crisis, the concern or the issue is not so much around the cost. It's basically around what do we do to avert, a worse situation or a worse outcome. The cost is obviously there. We're likely to see that Fed balance sheet that was kind of like being dialed back down almost a year ago continue to expand again. There are certainly implications, for that on the economy. Now more than ever before, the U.S. economy is looking like it might go into negative, interest rates because of how much those yields have declined, particularly on the 10-year U.S. Treasury over the last 2 weeks thereabout. Because if this crisis wears on and continues to go on, they might need to continue to even creates a more accommodative monetary policy situation. And, given the accommodative stance that we've had over the last decade, there isn't so much room to continue to do that. So that therein lies the sort of challenge that these central banks will have to grapple with down the road. However, right now, concern really is around, just keeping things together and keeping things safe.
What do you make of what the multilateral institutions are doing? IMF has done some trust scheme in this regard, something catastrophic, containment program.
Yeah.
And then you've got the United Kingdom supporting them with whopping £150 billion. That has also increased what they have in the CCRT to about $400 million now. Now, narrowing down to Africa, we have some multilateral institutions as well. Do you expect a situation where these guys will also borrow a lift from what the IMF is doing?
Well, that is likely to happen. We've got the African Development Bank continue to support a lot of projects, development around the continent. So, of course, it's not unexpected that, the African Development Bank might come up with such, a stimulus package. I think the idea is that, like I said earlier, is to have packages in place to ensure that if this situation gets worse, we are ready to sort of take care of it and deal with it. If the epicenter shifts, as we've seen, the epicenter of the crisis shifting from China now to Western Europe, if we have a situation where the epicenter shifts to poorer regions of the world, then those sort of stimulus packages by the IMF and all the multilateral agencies would come in handy, because obviously these regions do not have the wherewithal and the capacity to cope with this crisis. So, if that happens, we're likely to see, multilateral agencies here in Africa also come up with, stimulus
but
packages.
But it hasn't really gotten to such a stage.
We haven't seen that. What we are seeing basically across the continent is countries are taking steps and putting measures in place to ensure that they limit the spread of the virus, and also put structures in place locally to ensure that they are able to deal with it when cases do show up.
Because they currently are badly hit when compared to Africa.
Absolutely.
Yeah, so let's look at what the central bank has done in this regard. Yesterday they released like a 6 phases of package or something regarding the stimulus program that they are to. How would you describe what they've done, and how significant will that be for the markets, equity, money markets? Because these are portfolio investments, where we've got some kind of serious concerns.
Yeah, so I think what the CBN did yesterday, I would say, is quite commendable. I'd say that was also very proactive of them to, not wait for things to get bad or worse than they already are before they react. So what they've essentially done is to try and, limit or assuage the impacts or the likely impact of the crisis on economic activity, particularly for companies that are vulnerable, for small and medium-scale enterprises. That's why we've seen that 6-point agenda, if you will, where they are creating or extending a moratorium on repayment. They're also reducing interest on a lot of the CBN facilities from 9 to 5%. That should also ease the burden on companies that are likely to take a direct hit from the crisis. So I think it's quite commendable. What it would do to the markets honestly remains to be seen, because these are wildly volatile times. This should actually serve to, calm nerves. However, because of the level of volatility that we're seeing in the markets, that impact might not be so strong, right now. But I think that it would help. I feel that was a very good proactive move on the part of the Apex Bank.
I know that we don't do much of margin lending here as they do at the European space, because the left rates unchanged actually for the margin lending space, in that hemisphere. But here, we've seen what the CBN did for the real sector, which is the focus now, whereby they talked about the possibility of restructuring some of these loans that have actually gone out, and there are folks that took these loans are currently challenged, so they'll see a bit of restructuring from the commercial banks eventually. Shouldn't we see such a thing for fund managers as well, who have actually lost a lot of money in the market lately? There's no space right now for PFAs to even launch their money, to launch their funds now.
Well, the matter is that I don't know that the CBN has any, or the Apex Bank has got any responsibility to, provide that kind of support. But I think that with what it is doing, with the, the package they released yesterday, that should support the broader economy. And by extension, will certainly support financial markets and obviously the positions of money managers. So for a direct approach or some sort of direct intervention by the Apex Bank, I don't know that that's something that the Apex Bank will certainly be looking at. But I think that with what it is doing to ameliorate the impact of the crisis on the broader economy, that should trickle down to financial markets and by extension to fund managers.
Perhaps that will be a fiscal responsibility. Is that what you think?
Well, not necessarily.
Because
fiscal.
again, if you look back in history, some years ago we had when the Dr. Okonjo-Iweala was the coordinating minister for the economy and the minister of finance. She actually came in here. The stock exchange gave some kind of forbearance package to stockbrokers, as part of the fallout of...
the reason we had that was a lot of stockbrokers and money managers were significantly leveraged, right? And then, some forbearance had to come for that. But right now, since after that collapse in 2008, 2009, the whole margin lending situation has pretty much died down. So we don't have an industry that is overexposed or extended in terms of leverage. So we don't have that. Whatever exposure people have now would essentially be their own monies. So the situation is different, really.
So given what the CBN has done now, what will be the expectation from them when the NPC holds next week?
Well, I think the NPC will still have to focus on updating the situation, if you will. So if, we have some significant changes between now and when they meet, they will probably most likely provide some sort of update to what they have done yesterday. Also, very importantly, we would need to see some sort of policy posture or leaning as regards the FX situation, although they have come out last week to say, that there wasn't a devaluation and all of that stuff. Would like to see policy pronouncements and moves as to what the Apex Bank is actually doing to forestall that situation.
All of that will eventually provide some succor to the markets eventually.
We'll really see how that goes. These are really, really challenging times for financial markets.
I agree with you. Thanks a great deal, Victor Aloyi, Head of Portfolio at Commercial Partners. We appreciate your insights.
Thanks a great deal.
Back to you, Chimuzi.
Thank you, Temple. And we move now to the debt and currency market. I'm being joined by Dayo Ogundari, FX dealer with Access Bank, joining us from the FMDQ market, please. Good morning, Dayo. Thank you for joining us.
Good morning.
So how would you say the fixed income and currency markets have welcomed the CBN stimulus package?
So I'll start with the fixed income market. I think the bond market was a bit bearish yesterday, although we did see some trades, particularly on the medium end of the curve, particularly on the 27s and 28s. There was also a coupon payment of about 140 billion naira yesterday, so that gave some respite to the market as well. I think going ahead, we will see some caution in the market, particularly as market participants digest the inflation and inflation results. On the Treasury bills market, what we did see was a bearish market as well, although we did see some interest, particularly on the short to medium end of the curve, with internationals offering a supply and markets taking that supply up as well.
Now
on the NTB, sorry?
Go ahead.
Okay, and on the NTB side as well, we did see some demand as well from market participants, particularly on the short end of the curve as well.
All right, you are an FX dealer, right? So what is the Naira trading at the moment?
So the market closed. There was some improved liquidity in the market yesterday, and I think the CBN circular that was sent out last week did provide some comfort to the market. The NAFEX, or the INE rates, did appreciate slightly to about 378 levels, and so we'll just continue to see improved liquidity during the course of this week.
Of course, there will be a Treasury bill auction tomorrow. What are your expectations? And of course, regarding what the central bank has done yesterday.
So, well, we should see an OMO auction on Thursday. But again, I think because of the market liquidity, market rates went up to about 800 bips yesterday. And that was just because we had a system debit last week, the retail auction last week, and the wholesale market wholesale auction yesterday. So rates, we saw rates close at about 17.4% on OBB and overnight about 18%. So there's a 50-50% chance that there might be a no more auction on Thursday.
All right, thank you very much,
with about 300
Dayo.
billion maturing, yeah.
Okay, thank you, Dayo Gundare, FX dealer with Access Bank. After the break, we will do an opening call to London as well as the equities market here in Nigeria. Do stay with us.